All right, Andrew John here, and I need your full attention for the next few minutes. What I'm about to walk you through is not speculation, it's not theory, and it's definitely not another financial headline that disappears in 48 hours. This is about a structural fracture unfolding right now inside the American pension system, a fracture that affects more than 40 million people, and the timeline is no longer hypothetical, it's mechanical. On February 4th, 2026, the Pension Benefit Guaranty Corporation released its annual report. Buried deep in that report is a projection that should concern every single viewer. The PBGC's multi-employer insurance program, covering roughly 10 million workers in union and industry-wide pension plans, is projected to become insolvent by fiscal year 2032. Now let me translate what that bureaucratic language really means. When the PBGC runs out of money, the pensions it guarantees don't just get trimmed, they collapse. Benefits could be reduced by 80–90% or more. A retired truck driver expecting $3,000 per month could see that fall to $300. A construction worker counting on $2,500 could receive $250. This is not fear-based storytelling. This is the official government baseline projection, and it assumes no additional plan failures between now and 2032. If we hit recession, if markets decline, if more companies declare bankruptcy and offload pension liabilities, the insolvency timeline accelerates. This isn't a political debate. It isn't a proposal. It's mathematics already embedded in the system. Over the next few minutes, I'm going to explain how we reach this point, why the so-called solutions cannot work under the current structure, and most importantly, what this means for your wealth positioning in 2026. Because if you think this only impacts union retirees, you fundamentally misunderstand how systemic risk spreads through financial systems. By the end of this breakdown, you'll understand the asymmetric positioning that emerges when a $6 trillion sector begins failing in slow motion. So eliminate distractions, lock in. Let's break this down step by step. Before we analyze the crisis mechanics, you need to understand the foundation of every pension system ever created: actuarial math. A pension promises a fixed monthly income for life after retirement. To support that promise, contributions are collected during working years, invested and projected to grow at an assumed rate of return. The gap between what's promised and what's invested is called the funding ratio. A healthy pension sits above 80%, meaning it has at least 80 cents invested for every dollar promised. Below that, risk begins compounding. The most critical variable? The assumed rate of return. For decades, pension funds assumed 7 to 8% annual returns. That assumption was built on the 1980s and 1990s, an era of high interest rates, strong bond yields, and powerful equity markets. But that environment no longer exists. Since 2008, we've lived through near-zero interest rates, suppressed yields, and monetary distortion. To hit return targets, pensions increased risk exposure. They loaded into equities, private equity, real estate, leverage strategies, alternatives. During the asset bubble of the 2010s, it appeared sustainable. Now the macro regime has shifted. Rates are elevated. Commercial real estate is deteriorating. Private equity faces liquidity pressure. Exit windows are narrowing. Meanwhile, liabilities grow every year as retirees increase and lifespans extend. This creates a compounding funding gap. Poor returns increase the gap. The gap forces more risk-taking. More risk-taking increases fragility. And when returns disappoint, the spiral accelerates. This isn't incompetence. It's structural math. Now let's separate the two types of pension plans in America. Single employer plans, run by corporations like General Electric, IBM, Boeing, have largely been phased out. Companies shifted to 401ks because they couldn't sustain guaranteed promises. Risk was transferred to employees. The real danger lies in multi-employer plans. These cover workers across industries like trucking, mining, and manufacturing. The flaw is simple. When one employer fails, others must cover the deficit. When multiple fail, the system collapses. Industries like coal, print media, and unionized trucking have shrunk dramatically. In some plans, there are 4 retirees for every 1 active worker. That ratio is mathematically unsustainable. Enter the PBGC, created in 1974 as a pension backstop. For multi-employer plans, the annual premium is roughly $35 per participant. $35 to ensure benefits that could total $30,000 per year. That's not actuarially sound insurance. It's structurally underfunded by design. As reserves drain, statutory guarantees shrink. And when funds are depleted, benefit cuts become unavoidable. History confirms the pattern. United Kingdom pension failures led to capped benefits under the Pension Protection Fund. Greece cut pensions 11 times during its debt crisis. Detroit reduced pensions through bankruptcy restructuring. Courts ruled pensions are not immune. They can be modified. They can be reduced. Retirees are unsecured creditors. State-level pensions are also underfunded. Illinois, New Jersey, Kentucky, Connecticut. Funding ratios in some cases below 50%. States cannot print currency. Eventually, either taxes rise aggressively or benefits fall. Social Security follows the same trajectory. Trust fund depletion projected around 2033. Absent reform, automatic cuts near 20%. Medicare hospital insurance projected to face shortfall around 2031. This isn't one isolated weakness. It's layered systemic strain across every retirement structure, converging within the same decade. Now the uncomfortable truth. There are only 3 mathematical outcomes: print money, inflation raise taxes, economic contraction, cut benefits, politically disguised reductions. The likely outcome? A combination. But benefit reductions are unavoidable. So how do you position? Asymmetric wealth preservation. When systemic promises weaken, paper claims carry increasing risk. Physical precious metals, gold and silver, eliminate counterparty risk. Silver, historically volatile, often outperforms in monetary stress cycles due to its smaller market size. A 10-15% allocation in physical metal acts as structural insurance. Real assets, farmland, energy, water rights, preserve purchasing power during inflationary resets. Mining equities provide leveraged upside if metal prices reprice sharply. The asymmetry lies in limited downside versus substantial upside in crisis repricing scenarios. Now here's what matters. Assess your exposure. If your retirement depends heavily on pensions or government programs, understand their funding position. Diversify outside pure paper structures. Build optionality, because when institutional promises adjust downward, the window to reposition closes quickly. The pension crisis isn't approaching. It's already embedded. The only remaining variables are timing and severity. Your financial future depends entirely on how you prepare before the adjustment becomes public reality. Take action. Stay informed. And I'll see you in the next one.